Hey everyone, Couch Investor back to another video for today and the first earnings video of this season, and it's about Netflix. At the time of making this video, the stock is up around 14% after hours. Why is that? Well, it outperformed its own guidance and much better numbers than what the market was expecting. Of course, last quarter, the headlines, they're losing subscribers. Well, they gained subscribers and quite a lot. Obviously, we have some more news with regards to the ad-supported tier, with regards to gaming, with regards to the account sharing. So we're going to cover all of that in this video. If that's of any interest to you, probably because you clicked on it. But if you want to see more earnings video, we're going to cover a lot of companies this season. So maybe subscribe to the channel if you have not. Hit that thumbs up button, it will really help me out. And if you want to support this channel, check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Make sure to check out all the other links in the pinned comment. So let's first look at a couple of highlights and basically, well, Netflix showing us that they're doing much better than the competition. So they say here that Netflix has higher engagement than any other streamer with room for growth. So in the UK, Netflix accounts for 8.2% of video viewing, 2.3 times Amazon and 2.7 times Disney+. In the United States, Netflix accounts for 7.6% of TV time, 2.6 times Amazon and 1.4 times Disney+, Hulu+, and Hulu Live. And this is basically them putting like another, let's say, maybe cherry on top or something like that. Our competitors are investing heavily to drive subscribers and engagement, but building a large, successful streaming business is hard. We estimate they are all losing money, with combined 2022 operating losses well over $10 billion versus Netflix $5 to $6 billion annual operating profit. Shots fired. Now I'll put on the screen what they forecasted for Q3 and, well, I'll go over the actual numbers so it's easier for you to compare. So revenue came in at $7.9 billion. They were expecting 7.8, year-over-year growth of 5.9%. Then operating income came in at $1.53 billion. They were expecting $1.25 billion. Operating margin came in at 19.3%. They were expecting 16%. Then net income of $1.39 billion. They forecasted $961 million. And diluted earnings per share came in at $3.10. They were expecting $2.14. Now, as for the global streaming paid memberships, now that totals 223.09 million. They were expecting 221.67 million. So year-over-year growth here of 4.5%, and they added 2.41 million. They were expecting to add just 1 million, but in my opinion, they were just sandbagging. It's always better to start low and then outperform. Now, as for free cash flow, you can see here $472 million, much better than the last quarter, a bit less than Q1, but still much better than the year before. Now, as you can see, for next quarter, they expect revenue to be down quarter over quarter, and they explain here why. Basically because of the, well, appreciation of the US dollar, it remains a significant headwinds for them because, well, the majority of their business is outside of the United States. But on a constant currency basis, this equates to 9% year-over-year growth in revenue. They also expect to add another 4.5 million streaming paid net addition for next quarter. So quite a different picture today than in the last 2 quarters. Now for this quarter, let's see where these subscribers came from, because we've seen that last quarter, yes, United States and Canada, that's where they lost the most. And that's obviously the ones that pay the most for their subscription. So in this quarter, it's nice to see that they added not that much, but at least they didn't lose any. In Europe, Middle East and Asia, they added as well 500,000 there. Latin America, they added as well. And APAC, they added 1.4 million, so the most out of the rest. But ARPU is obviously lower as well. But it's nice to see that this quarter, well, they haven't really lost any subscribers overall in each and every area. And we also have some news with regards to how they're going to report in Q4 and onwards. So revenue is their primary top-line metric. So starting Q4 2022 letter in January of 2023, we'll continue to provide guidance for revenue, operating income, operating margin, net income, EPS, and fully diluted shares outstanding for the following quarter, but not paid membership. Similar to our regional membership disclosure, we'll continue to report our global and regional membership each quarter as part of our earnings release. This is of course because, well, of the new addition of the advertising side of the business, so we're anyways going to get much more details when that is up and running. Now, a couple of things with regards to their content. So here I compare, obviously, the three, let's say, most popular shows right now. Dahmer, Jeffrey Dahmer, Rings of Power from Prime, complete disaster, and House of Dragon, loved it. As you can see, and no surprise here, Rings of Power is, well, the lowest one. Then House of the Dragon and Jeffrey Dahmer, well, I don't know why, but weird murder horror shows always make so much noise and become extremely popular, as you can see right here. Now, a couple of extra things here with regards to gaming. So they're coming up on their 1-year anniversary of their gaming launch. As we've said, this will be a multi-year journey for us to learn how to please game players. Our first year was about establishing our gaming infrastructure and understanding how our members interact with games. We now have 35 games on service, all included in every Netflix subscription without in-game ads or in-app purchases. And we're seeing some encouraging signs of gameplay leading to higher retention. With 55 more games in development, including more games based on Netflix IP, this is very important, we're focused in the next few years on creating hit games that will take our game initiative to the next level. More generally, we see a big opportunity around content that crosses between TV or film and games. For example, after the launch of the anime Cyberpunk Edge Runners, amazing one, 49 million hours viewed in Q3, use of CD Projekt's game surge on PCs. Basically, the popularity of the Cyberpunk game suddenly exploded. And now with regards to product and pricing, and obviously the announcement of the ad-supported subscription plan, they say here that the launch in all of these markets, Australia, Brazil, France, Germany, Italy, Japan, Korea, the UK, the US, and we launch in Spain November 10th, Mexico and Canada November 1st. Cumulatively, these 12 markets account for around $140 billion of brand advertising spent across TV and streaming, or over 75% of the global market. Just a little taste of what's to come. Now, they say here that the reaction for advertisers so far has been extremely positive, and we believe that more choice, especially more price-conscious consumers, will translate into meaningful incremental revenue and operating profit over time. That said, it is still very early days, and since we're keeping our existing plans ad-free, it will take us time to build up our membership base and the associated ad revenue. So obviously don't expect next quarter to already have like huge numbers. Finally, we landed on a thoughtful approach to monetize account sharing, and we'll begin rolling this out more broadly starting in early 2023. After listening to consumer feedback, we are going to offer the ability for borrowers to transfer their Netflix profile into their account and for sharers to manage their devices more easily and to create sub-accounts, extra member, if they want to pay for family or friends. In countries with our lower priced ad-supported plan, we expect the profile transfer option for borrowers to be especially popular. Here they talk again about the competition, but the most important metrics I've mentioned at the start of this video with the operating profit. And last thing here, we have no debt maturities in 2023. In early October, we closed our previously announced acquisition of leading animation studio Animal Logic. We funded the transaction with cash, which will be reflected in their Q4 cash flow statement. So overall, if you ask me, great quarter by Netflix, proved all the haters wrong that said, oh, Netflix is dying, nobody's watching things on Netflix, they're losing subscribers, blah, blah, blah. Well, Netflix clearly shows that they're here, they are still the biggest out there, and whenever there is a hit show, well, it's mostly Netflix. But I do not own this stock in my personal portfolio. Now that I'm watching the stock, I wish I did. Maybe you have it in your portfolio. Obviously, do share your thoughts down in the comments below. I love the company. I love the service. I continue to watch great shows. I'm now watching a sitcom called Kim's Convenience. Very, very funny. Anyways, what have you been watching lately? What do you think about this quarter? Let me know down in the comments below. Enjoy this type of videos, leave it a thumbs up. If you haven't subscribed to this channel, maybe that subscribe button, and I'll see you all in the next one. Bye bye.